Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
Welcome back to Retirement Unlocked with your host, Larry Heller. As we approach the end of the year, it's a perfect time to talk about taxes and the smart moves you can still make before December 31st. From maximizing deductions to taking advantage of last-minute opportunities, a little planning now can make a big difference coming this tax season. Joining Larry today is Jonathan Niyazov, who is a New York-based CPA with experience at firms like BDO and Baker Tilly. Jonathan specializes in helping clients reduce tax liabilities and plan strategically for the year ahead. Together, they'll walk through practical year-end tax tips to help you keep more of what you've earned and start the new year on the right foot. Larry, take it away.
Thanks, Matt. Thanks, Jonathan, for joining us today. We're going to talk a little bit about some tax tips as we get close to the end of the year. So why don't we start kind of with that big, beautiful tax bill and some of the, kind of overviews. We're going to talk about some of the quick overviews. We're not going to get into everything, and we're not going to get into depth of everything, but let's talk about some of the quick ones. Why don't we kind of start with some of the changes that they've made to the deduction limits, the personal exemption limits? Why don't you kind of go through some of those, Jonathan?
Of course. I mean, that bill was really a sight. So many things covered, so many changes. Amazing, I would call it. So my most favorite change is the state and local tax deduction. So before it was capped at $10,000. Currently, the cap has been raised to $40,000. This will allow residents of states like California and New York to increase their itemized deductions, thereby reducing their tax liability. Another limit, sadly, with the good comes the bad. A new limitation has been applied for itemizers, where the tax deduction will be limited if you have income of $750,000 or more for married filing joint taxpayers. They temporarily brought back the personal exemption for senior citizens and set it at $6,000, which is amazing. Now, they also canceled out the personal exemption for all other taxpayers. So we'll most likely never see the temporary, the personal exemption come back for individual taxpayers who are younger than 65.
You mentioned a lot of things there with deductions and exemptions. So the state tax, the big issue for a lot of states, as you mentioned, New York and California, was you were limited to $10,000 that you could deduct on your federal. And now they raised it to $40,000. But aren't there some limits? So even though they raised it, they could catch you another way.
Of course, there's always limits when it comes to new legislation. So this particular deduction is going to start to phase out at about $500,000, and sadly, this is temporary increase, and it will expire in 2030. So we'll be talking about this again in 2029 most likely.
Okay. And the same thing, I guess, with the personal exemptions. They bring this back for senior citizens. What is it? I think it's age 60 and over, or age 65 and older. I'm not sure.
I believe 67.
67.
I got to go back and check.
They're bringing that back out. But again, it sounds great, but aren't there phase outs of these as well?
Of course. So if you have 75,000 or less, you will be able to use the full $6,000 exemption. But after 75,000 or more of income, you will the exemption will start to phase out.
All right. So you hear all these great things they put in the bill, but it could be dramatically limited based upon what you earn.
Correct.
Let's touch on a couple other items, such as the child tax credit. Again, what is that? Who is it going to affect? Why don't you give us a little bit more insight into that?
So the child tax credit has been increased from $2,000 to $2,200. And if you're married filing jointly, you will not be limited in the deduction up to $400,000. After $400,000 of income, your deduction will be limited and will decrease accordingly.
So again, if you're in the really high net worth, a high income producer, which I guess, could come into play. I know we're going to talk about some tax planning items, but if you're able to kind of manipulate your income from one year to the other, you may be able to qualify on some of these exemptions in one year and not qualify in different years. So it's important that you get some tax advice, such as Jonathan, to make sure that you're planning for this if you can. Let's talk, kind of switch gears a little bit. If you are a business owner, there's the qualified business income deduction. Why don't you explain a little bit about that and maybe how that has changed in this big, beautiful bill?
So the qualified business deduction, income deduction, is actually my favorite of all of the deductions available for business owners. What it does is it allows you to take 20% of your business income and actually reduce your taxable income by that 20% on page 1 of the tax return. There are many different types of businesses though. So for real estate professionals, as well as architects, there is no limitation to this deduction. Sadly, for people that are attorneys or accountants, the deduction is limited and starts to phase out after $400,000 of income on the married filing joint tax return.
Interesting. So, Jonathan, when you mentioned a few others, and we're not going to go into detail, but a few others of the changes that are coming with this bill.
Yeah. Oh, there's definitely a ton more. To just name a few, we have non-taxable tip income up to with limits as always. Overtime pay not subject to income tax with certain limits in place. And you're even able to deduct car loan interest, which in the past has been considered a personal expense. That is a biggie. That's a huge one. Of course, it's limited up to a certain amount, but still being able to deduct it nonetheless, it's a game changer.
So a lot of things coming with this big, beautiful bill. So if you're not aware of them, you need to reach out to your accountant and find out what they are and which ones you may be eligible for, and which ones you may want to consider. If you can defer some income into 2026, you may be better off to qualify for some of these. So, and that's part of the things that you do, as the year is coming to a close, what can you recommend to individuals for year-end tax planning?
The first and most important thing I can recommend is to be aware of the tax changes that stem from the big, beautiful bill. I'm saddened to say this, but most sole practitioners and tax preparers out there do not keep up with the changes and oftentimes miss out on large deductions. I had a client come in last year, and this was quite shocking to me. So this client came in, and they actually overpaid their tax by $500,000.
Whoa.
Yes, a big amount. $532,165 to be exact. The number is still fresh because it just stood out to me. Luckily, the statute of limitation was not closed on that, and we were able to file amended tax returns. But that is a huge mistake that was completely overlooked. And the mistake stemmed from the qualified business income deduction as well as the New York State PTET.
So that's a good point. So one of the things you do is actually look at, I don't know, how many years can you go back and look at tax returns and maybe make adjustments, Jonathan?
So you have 3 years to go back from the date of filing. So if your tax return, let's say, was filed on October 15th, let's say your 2021 tax return was filed on October 15th, 2022. So technically, you were able to go back and refile up to 3 years from October 15th. So you were able to. So I'll make it a little clearer. So on October 15th, 2025, you were able to go. Prior to October 15, 2025, you were able to go back and amend 2021. So currently, 2022 is opened for amending.
Right.
22, 23, and 24.
You were able to take a look at this client and see that they made mistakes. I'm sure that's that's a very happy client after you were able to have that conversation with him.
Oh yeah, he was ecstatic.
Okay, so what are some of the other planning items that you could do for year end?
So for stock traders, I would recommend considering to sell lost positions to offset capital gains realized in 2025. Now, I'm not providing financial advice. I'll leave that up to you, Larry. This is purely from a tax benefit perspective. 2025 has been an amazing year in the market. Hence, offsetting any gains would be beneficial, especially if you have some stock that you've been holding for years now and it's in a loss position. I mean, this is the perfect time to do it.
Yeah, and I'll give you kind of a little tidbit of what we do. We do what's called tax loss harvesting, that you can actually sell a position, buy a similar position in case the market goes up. So let's say you have Coke and you have a gain in it, but you like Pepsi, you can sell Coke and buy Pepsi the same day. And then you wait 30 days and you can buy the stock back. And it works the same thing with funds. So looking at ways of getting a tax savings without getting out of the market, great strategies for doing. So thanks for sharing that, Jonathan. Any other ways to reduce your liabilities?
Another item to consider as people might be seeing reduced tax liabilities this year. Well, this is not to reduce your tax liability, but this is more of a long-term planning strategy, I would call it. So currently, because of the new legislation, people will be seeing reduced tax liabilities this year. And what I would recommend is to take your 401ks and your IRAs and convert them to a Roth account. Now, like I mentioned before, there will be additional taxable income on this, but once you pick it up, any future gains in the Roth account will not be taxable to you and will be distributed tax-free. So imagine currently you're 30, 35 years old and you convert from a 401k to from a regular IRA or a 401k to a Roth. You have the next 24 years to appreciate the value of that account, and all of that appreciation will be tax-free. And upon distribution, there will be no tax liability whatsoever. I think that would that's a great planning tool.
Yeah, so it's music to my ears. We're actually spending right now going through every client and see where it makes sense to do some of these conversions. You got to be careful about some of the rules about penalties and that, and you got to look at your tax brackets now. But we've done a few different podcasts on that. So you can check out one of the podcasts that we recently did on Roth conversions. Why don't we switch gears and kind of, be remiss to not talk about, business owners and some of the new changes for business owners. So any helpful tips for business owners to help them reduce their tax liability for 2025?
Well, the big beautiful bill came back with bonus depreciation at 100% and made it permanent. As a comparison, in 2024, you were only able to deduct 60% of any new assets via bonus depreciation. Currently, they made the 100% bonus depreciation permanent, which can technically allow you to deduct any asset that you put into service in 2025, apologies. So if you were putting off buying new assets because of the bonus depreciation and the fact that you weren't able to deduct it in 23 or 24, I would probably put forward these plans and buy these assets as in 2025 before the year end. That will drastically reduce taxable income.
Yeah, again, something new that need to be out there before the end of the year to take advantage of that. It's a big savings.
All right. Another one, which is my one, which is a very good one, and if you don't already have one, I would highly consider and getting one would be retirement plans. When offering retirement plans to employees, not only will it boost up employee retention, but it will also provide the company with very nice tax incentives in the forms of credits and deductions that wouldn't otherwise be available. Larry, you had assisted me with these in the past, and they have been proven to be effective for my clients.
Yeah, again, they're a little complicated trying to figure out what qualifies and what doesn't qualify. But yeah, and the rules have changed on here. But yeah, if you haven't put a plan in place, and the good thing about retirement plans, now they change the rules. You got plenty of time in 2026 to put one in for 2025, although you really shouldn't wait.
Well, that was one of our issues last year, I believe, when we were a little rushed.
Yep. So, and what about self-employed folks? You know, they can do this as well, correct?
Correct. For self-employed folks, you have something called a Simplified Employee Pension, or SEP. It's an amazing tool, and it reduces your tax liabilities. Once created, it allows you to contribute to a SEP retirement account about 20% of your taxable income, up to $70,000. And that $70,000 will reduce your taxable income dollar for dollar.
Let's talk about, let's talk about credits. And why is a credit so good, and why are there credits that will allow you to reduce your tax liability?
So credits, for the most part, will actually are a little bit better than just a tax deduction, because credits will actually reduce your tax bill by the amount of the credit. One of my most favorite credits, and the lowest hanging fruit, would be the R&D credit. As long as so a lot of companies say we probably will not be able to qualify for these credits. Well, with the R&D credit, as long as you are spending money to build a new system, develop technology, improve upon current technology, to name a few, there's a good chance that you will qualify to take advantage of the R&D credit. Now, this credit, this money has already been spent by companies, by entities, and in order to kind of take advantage of them, all you need to do is ask your advisor and see if you qualify. And like I said, the threshold for qualifications are very low.
You know, these are great tips, great ideas, and I'm sure we've only touched a few of them. They're complicated. They've got different thresholds. They got different limits, and there's so many that can help you save your taxes. But you need to make sure that you're taking care of them before the end of the year. Jonathan, any final thoughts or ideas on any tax planning before we wrap this up?
Of course, I mean, we just touched on the top, but there's plenty of stuff out there. One of my most important things that I always recommend when anybody comes through the door is always to make sure you have the right structure in place. The right structure will ensure you are paying the least amount of tax and saving the most capital to reinvest back into your business.
So when you mean the right structure, mean LLC versus S corp versus sole proprietor? That's what you're talking about.
Correct. Well, sometimes yes. In the beginning, that's how you start off. Once you rev up operations, it might be beneficial to put additional entities in between or separate the different types of income and expenses in order to get you to the place where you want to be. So let's say, for instance, if you have a C corporation, you're taking money out most likely through a W-2 as an employee or an officer of the entity. Now, if you have an S corporation, you don't need to pay yourself such a high salary, and then you have distributions that you can take out. In an S corporation, you're technically paying less self-employment tax than you would in an LLC. So this is just a quick 30-second kind of overview of the different structures that are available, and kind of custom tailoring these structures, these entities, entity types to the actual activity. That's where the money savings comes in.
So if you're looking for a new account that can kind of help you with all these designs, or even checking to make sure that you didn't overpay your taxes in previous years, reach out to Jonathan. Jonathan, where's the best way if somebody can get a hold of you?
The best place would be to give me a call on my office line is 929-522-0607.
Great. Thank you so much, Jonathan, for joining us today.
Thank you for having me. It was a pleasure.
And we will make sure that we have Jonathan's contact information in the show notes. So thanks for joining us on Retirement Unlocked. If this episode helped you gain better understanding of year-end tax strategies, be sure to like, share, and subscribe with somebody who could benefit with this before tax season hits. Want to make sure you're maximizing every opportunity before December 31st? Click the episode description for a link to Heller Wealth Management, where you'll find additional resources and the option to schedule a complimentary 20-minute call with our team. Smart tax planning starts with smart decisions. So let's start that conversation today. We'll see you next time on Retirement Unlocked.